Welcome back to the deep dive. It is February 12th, 2026. Today, we are doing something a little bit different. We are doing what we're calling a second look.
That's right. A second look, taking a step back from the usual headlines.
Exactly. I mean, usually when we talk about real estate, whether it's on this show or, just chatting at a dinner party, we tend to stick to the basic.
Oh, yeah. The big three.
The big three, you know the drill. Location, location, location.
Can't escape it.
Never. Then it's, what are the interest rates doing this week? What's the square footage? And the big one, does it have an open concept kitchen? All the stuff you see on the flyer.
The surface level stats, the things you can easily measure and put in a spreadsheet.
Right. But today we are ripping up the floorboards. We are going underneath the house, so to speak. We're looking at the invisible machinery that actually determines whether a neighborhood is about to skyrocket in value or, slide off the map entirely.
It's the difference between looking at a photograph of a street and looking at an X-ray of that street. We want to understand the whole life cycle of a neighborhood. I mean, how do you spot the next big thing before the prices even begin to reflect it?
And what actually happens when that flood of money comes in? Who wins, who loses?
And maybe the most important part for 2026, and it's a little creepy, how does big data already know more about your street corner than you do?
It's a great question. And to answer it, we have a really fascinating mix of sources today. It's a really diverse stack. We're pulling from some heavy hitters. There's high-level analysis from McKinsey on AI and real estate.
Very corporate, very data-driven.
Very. Then we had some really deep sociological studies on gentrification from the NCRC and various academic journals. So that's the human impact side.
The theory behind the numbers.
We've also got practical investment guides on something called the path of progress, kind of the boots-on-the-ground playbook. And then, and this is my personal favorite, we have what I think is probably the most honest source in the entire stack.
I know where you're going with this. The Reddit thread.
The massive, sprawling Reddit thread. It's essentially a forum where thousands of people just listed the unwritten signs of neighborhood value. The stuff a real estate agent won't tell you, but the neighbors absolutely know.
That thread is a goldmine. I mean, it is pure, unadulterated sociology disguised as internet chatter. It's people pattern matching in real time.
So the mission today is to decode the neighborhood. We are moving beyond vacancy rates and square footage, and we're looking at, the price of a latte? Or whether the local convenience store has a specific type of security glass.
At the end of the day, it's all about pattern recognition. And it doesn't matter if you're a billion-dollar endowment fund with a team of PhDs or a young couple just looking for a starter home. The game is the same. Can you see the pattern before everyone else does?
Okay, let's unpack this. I really want to start with that eye test. Because before we get to the algorithms and the satellite imagery, real estate is physical. It is tactile. It's what you see when you walk down the street.
It's what you feel.
Yes. And according to our sources, especially that forum discussion, there are these unwritten signs that just scream value or a lack of it.
Right. And what's so fascinating here is that humans are naturally pattern recognition machines. We all are. We pick up on these cues subconsciously. You walk down the street and you feel safe or you feel anxious. You might not know why.
You just get a vibe.
You get a vibe. But when you list those signs out, as they did in that massive discussion, it becomes a distinct economic language. You're translating the vibe into data.
So let's talk about the good signs. The stuff that tells you a neighborhood is about to pop. The classic one, the one everyone sort of knows, is coffee.
The coffee shop index, if you will. It's almost a cliche at this point.
But it's not just, is there coffee?
Right.
Right. Because I can get coffee at a gas station. That doesn't mean my property values are about to double.
No, the nuance here is absolutely critical. It isn't just a Dunkin' Donuts or a generic pot of brew. The specific signal, the one the Reddit thread really honed in on, is the independent shops. And, as one observer noted in the source material, it's specifically about the milk.
The milk.
The milk. Seriously, if you walk into a coffee shop and they offer 5 different types of milk, almond, soy, macadamia, pistachio, that is a very, very specific demographic signal.
Okay, you have to break that down for me. Why? Why does macadamia nut milk equal higher home prices? That seems like a stretch.
Well, think about what it represents. First, on a basic level, it signals a customer base with disposable income. All those milk alternatives are expensive, right? They cost way more than dairy.
$1 extra per latte, easy.
At least. But more importantly, it signals choice as a lifestyle value. It signals a population that has the time and the luxury to be particular about their dietary preferences. It implies a fundamental shift from sustenance, which is, I need caffeine to wake up, to experience, I want my specific bespoke latte ritual.
That makes perfect sense. It's the specific versus the generic. It's a luxury good, even if it's a small one.
It's a micro-luxury that indicates macro trends.
Okay, another one that cracked me up when I read it, but then it made total sense, is this fitness shift. We aren't just talking about a gym opening up.
No, not at all. A Planet Fitness opening up signals one thing about the local economy. A high-end Pilates studio or a, Padel club signals something entirely different. The price point, the clientele, it's a different world.
Right.
But there was one specific observation from those social forums that I found incredibly astute. It was the presence of women jogging with weighted vests.
Okay, hold on. Weighted vests. You're telling me that seeing someone deliberately make their run harder is an economic indicator.
It sounds completely counterintuitive.
Right.
But just peel back the layers for a second. Think about what a weighted vest actually represents. First, it's a specific piece of fitness gear. It costs money. It's not something you just have lying around.
Sure.
But more importantly, it represents what you could call volitional struggle.
Volitional struggle. I like that.
Exactly. I mean, think about it. If your life is already physically hard, if you work manual labor, or you're exhausted from working 2 jobs to make ends meet, the last thing you do is strap 20 pounds of lead to your chest for a morning jog. You don't add weight to your day.
You're trying to take weight off.
You only do that if your life is comfortable enough that you need to manufacture difficulty for health benefits.
So it's a luxury signal. It's a subconscious broadcast that screams, I have the time and the energy to suffer for fun.
Precisely. And there's a massive safety component baked in there, too. You don't run around with headphones on and a weighted vest, which literally slows you down and makes you more vulnerable, unless you feel completely, utterly secure in that environment, day or night. It is a loud, unspoken broadcast that says, this street is safe.
That is actually kind of profound. And I guess that connects directly to the other very specific sign the Reddit thread mentioned, the dogs. The Doodle economy.
Ah, yes. The dog breeds are a surprisingly, almost frighteningly accurate economic indicator.
It's the Doodles versus Pitbulls ratio, right? And I want to be really clear here. We aren't judging the dogs themselves. My cousin has a Pitbull. It is the sweetest dog I've ever met. But we are talking about what the choice of breed signals about the owner's intent and their circumstances.
Crudely put, yes. And it's not a moral judgment. It's just an observation of patterns. It's about utility versus lifestyle. An influx of doodles, golden doodles, labradoodles, bernedoodles often correlates with higher disposable income and young families moving in. These are expensive dogs.
Very expensive.
They're high maintenance, often chosen for specific traits like being hypoallergenic or a certain temperament for kids. They are, in essence, lifestyle companions.
Whereas a high prevalence of what are traditionally seen as guard dog breeds
Can signal that the perception of safety hasn't shifted yet. It really asks the question, what is the dog for? Is the dog a member of the family that sleeps in the bed and has its own Instagram account? Or is the dog a security system for the front yard? When that ratio shifts from security to lifestyle, the property values are usually already on the move.
It's a wild way to look at it, but I can absolutely see it. Okay, another one from the good signs list. Young people doing low-budget DIY renovations. Sweat equity.
Yes, this is a huge one. It's the precursor to the full-blown flip. You see a young couple, they've bought the worst house on the best block they could afford, and they're out there on a Saturday, covered in paint, tearing out old shrubs.
Right, they're not hiring a big crew. They're doing it themselves.
That's the key. It signals that the neighborhood is affordable enough for people to get a foothold and that they have the optimism and energy to invest their own labor. They see a future there. That sweat equity is the first wave of investment. After them come the professional flippers who bring the big money.
And what about LGBTQ plus flags? The sources cite this as a leading indicator.
It's frequently cited as one of the earliest signs of revitalization or gentrification, depending on your perspective. Sociologically, it's often seen as a signal of a tolerant, open community which attracts other creative class professionals and artists. It's an indicator that a neighborhood is becoming more diverse and progressive, which often precedes economic investment.
So it's a cultural signal that predicts an economic one.
Exactly. It's all part of the same mosaic.
Okay, so those are the green flags. Now we have to talk about the red flags. What are the unwritten signs that a neighborhood is sliding the wrong way or is already in distress?
The commercial decline is usually the first and most visible symptom. And it's not just for lease signs. It's the specific types of businesses that open up.
Right.
We buy gold stores are a classic harbinger. Payday lenders, check cashing spots, rent-to-own furniture stores.
Why those specifically? What's the common thread?
They all thrive on liquidity crises. They are businesses that cater to the unbanked or underbanked. They appear where people need cash now and don't have access to traditional credit or banking. If a We Buy Gold store opens, it means there are enough people in the local market selling their wedding rings and heirlooms to pay the light bill. That is a five-alarm fire as a sign of economic distress.
And there was one detail from the sources that really, really stuck with me, the retail defense mechanisms.
A plexiglass barrier.
The plexiglass, yes, but specifically the carousel. I'd never even heard of this.
Right. Can you describe it for the listeners? It's a powerful image.
It's jarring. You walk into a convenience store, and there are no goods on the shelves that you can actually reach. Everything is behind bulletproof glass. You tell the clerk what you want, you pay, and then the clerk puts your bag of chips or your soda into this spinning plastic drum, a carousel, and spins it around to you.
You never touch the clerk. The clerk never touches you.
It's completely impersonal.
It is. Now, think about the economics of that carousel for a second. It slows down every single transaction. It creates friction, it costs a lot of money to install, and it makes every single customer feel like a potential criminal.
It kills the vibe completely. There's zero trust.
It does. So why on earth would a business owner do it? They do it because the perceived transaction cost of trust is too high. It says that the business anticipates theft or violence, not as a possibility, but as a baseline operational reality. If you see the carousel, the neighborhood is in a deep, deep defensive posture.
Wow. And on a much smaller scale, another one was paying extra for ketchup at a fast food joint.
It seems so small, right? A 10-cent packet of ketchup.
Yeah.
But it's about margins. It suggests the local franchise is operating on such razor-thin margins or experiencing such a high rate of loss from theft or waste that they have to monetize the condiments.
Things we all just assume are free.
Right? It's a tiny microeconomic signal of a much larger macroeconomic problem in that specific location.
It's depressing, but it is data.
It is absolutely data. And that leads us directly to the physical decay signals. And we're not just talking about old houses. We're talking about specific types of neglect that tell a story. Mattresses on porches.
A classic sign.
A very classic sign. Blue tarps on roofs when there hasn't been a hurricane in 6 months or a year. That's not a temporary fix. That's a permanent state of disrepair.
And the car-to-bedroom ratio.
Exactly. This is a brilliant one. If you see a 3-bedroom house, but there are 5, 6, 7 cars parked on the lawn, not in the driveway, but on the grass, it's a strong indicator of overcrowding.
It suggests multiple families or multiple wage earners living in a single dwelling just to make rent.
That's a sign of intense economic stress. Even if the official property values on Zillow haven't collapsed on paper yet, the lived reality is already there.
So we had these observations. We're walking the streets, we're counting the doodles, we were looking for the weighted vests and the blue tarps. But how do we turn that into an actual strategy? That brings us to this concept from the sources of the path of progress.
This comes from the MI and Legacy Real Estate team sources. The path of progress is essentially the art of identifying where the growth is going to go, not where it already is.
Right, because if you buy where it already is, you're too late. You're paying the premium.
You're paying for yesterday's news. This is the skeet to where the puck is going of real estate investing.
So how do you do it? One of the most effective tactics they mention is follow the leader.
Right.
This is the idea that we as individuals don't need to do all the expensive research because the big guys already did. Isn't that a bit lazy, though?
I wouldn't call it lazy. I'd call it efficient. Think about it. A company like Costco or Whole Foods or Home Depot or even Starbucks, they have entire departments of data scientists and market analysts. They spend millions of dollars a year on this stuff.
They're not just throwing a dart at a map.
Oh, absolutely not. They're analyzing traffic patterns, income levels, future zoning maps, population projections. They know where the demographics are shifting years before the official census data comes out. They have access to data we can't even imagine.
So they're basically doing the homework for us.
If Costco is buying a huge parcel of land in a fringe neighborhood, a place that maybe looks a little rough around the edges right now, you can bet they have run the numbers. They know the population growth is coming. As an individual investor or even just a home buyer, you can draft off their due diligence. You just follow the big box trucks.
That makes a lot of sense. And then there's the other key strategy, the spillover effect.
This is absolutely crucial, especially for people who feel priced out of the hot markets. It's pretty simple. If a hot neighborhood becomes too expensive, let's say everyone wants to live in neighborhood A, but a starter home there is now $1 million, where do those people go?
They don't just give up.
They don't give up, and they don't move to the other side of the city where their friends and jobs aren't. They move to the adjacent neighborhood, neighborhood B. They spill over the border.
So you look for the friction points, the edges.
Exactly. You look at the borders of the hot zones. That is where the next wave of value is created. If you can identify the neighborhood next to the cool neighborhood, the one that's still a little gritty but has good bones, you are looking at the future path of progress.
And infrastructure is the skeleton that this entire system is built on.
100%. New transit lines, highway expansions, bridge repairs. These are massive government commitments. A city doesn't spend billions of dollars on a new light rail line if they don't expect and encourage density to follow. Infrastructure is the government's promise of future activity.
Okay, so that's the eye test. That's the street smarts. It's fascinating. But we are in 2026. The big players, the hedge funds, the institutional investors, the endowments, they aren't just driving around looking for blue tarps and doodles. They're using algorithms.
They are using big data. And this is where it gets really, really interesting and, frankly, a little intimidating. This moves from observation to prediction.
So let's dig into this McKinsey analysis. They draw a really important distinction between traditional data and non-traditional data.
Right. Traditional data is fundamentally retrospective. It looks backward. It asks questions like, what did a house down the street sell for last month? It's the vacancy rate, the median income from the last census. It's useful, but it's history. It's like driving by looking only in the rearview mirror.
And the new era is predictive.
Predictive and hyperlocal. We are talking about unbelievably granular data points that seem, on the surface, to be totally unrelated to real estate, but are actually highly correlated with value.
Okay, let's go back to coffee for a second, the coffee correlation. This isn't just a vibe check from a Reddit thread. There are hard numbers here from academic studies.
This is a staggering stat. A study looked at Boston between 1997 and 2014. It found that homes within a quarter mile of a Starbucks appreciated by 171%.
171%.
Compared to the citywide average of 126%. That is a massive, massive spread. Now, of course, that brings up the chicken-egg question.
Right. Does the Starbucks cause the value to go up, or does Starbucks just have an incredible real estate team that knows where the value is about to go up?
It is. And it's likely a bit of both. It becomes a self-fulfilling prophecy. But as a signal, as a data point for an algorithm, it's incredibly powerful.
But the data also shows something McKinsey calls non-linear relationships. I found this fascinating. Specifically, the too much of a good thing rule.
Yes. This is where it gets counterintuitive.
Wait, you're telling me you can have too much coffee? Or too many grocery stores?
You could have too much retail density, yes.
Right.
For example, the data shows that having 2 specialty grocery stores nearby, say, a Trader Joe's and a Whole Foods, boosts home values significantly. Everyone loves that.
Sure, I'd want that.
But if you have 4 specialty grocery stores in that same small radius, the prices actually correlate with being lower.
Wait, why? Why would 4 Trader Joe's make my house worth less? I would love that. The parking might be bad, but...
Yeah. The parking is exactly the point. You might love the cheese selection, but the algorithm sees saturation. It suggests the area has become overly commercialized. It means traffic is a nightmare. It means the residential character, the quiet streets where kids can play, has been completely swallowed by commerce. The algorithm knows that there is a sweet spot for amenities and density, and once you cross that threshold, value actually starts to drop.
That is wild. It's a level of nuance that a simple human observation might miss. And they are looking at even weirder stuff. You mentioned swimming pools.
The number of building permits issued for swimming pools in a given area. It's a proxy for disposable income and a shift toward leisure and home improvement. They're also looking at the tone of Yelp reviews.
The tone, what do you mean? Like if the food was good?
Not just the star rating, but the actual sentiment analysis of the text. They use AI to read the reviews. Are people reviewing the local bistro and saying, great food, but I felt really unsafe walking back to my car? Or are they saying, amazing vibe, we loved walking around the neighborhood afterwards? That sentiment analysis predicts neighborhood safety and walkability faster and more accurately than official police crime stats do.
Okay, I have to circle back to something that was in the outline because it blew my mind. In-office mobility, tracked by elevator movement. How on earth are they getting that data? Are they hacking into the building's security system?
It's actually simpler and, in a way, creepier than that. It's often the Internet of Things, or IoT. Most modern commercial elevators are connected to the cloud for maintenance and diagnostics. They generate logs. Big data firms can buy aggregated, anonymized data sets that show lift usage intensity by time of day and by floor.
So they know in real time if the 40th floor is taking a lunch break or if the entire building is empty on a Tuesday.
That's it. If the elevators are moving constantly, people are working, businesses are thriving, the building is full. If the elevators are idle for days on end, that building is a ghost town, even if the tenants haven't officially broken their leases yet. It's real-time occupancy data that's months ahead of official vacancy rates,
And then you layer on the cell phone data on top of that.
which tracks foot traffic patterns.
Yeah.
This is the hyperlocal lens McKinsey is talking about.
Right.
They aren't looking at how many people live in Seattle anymore. They're buying data that lets them ask, where did the device IDs associated with a high-income profile go for dinner on Tuesday night?
That feels incredibly invasive.
It is, but for an institutional investor, it's a crystal ball. McKinsey ran a comparison case study of two buildings in the same Seattle zip code. On paper, using traditional data, they looked identical. Same year built, same square footage, same number of units. But one was valued 30% higher than the other. Why?
Let me guess. The hyperlocal stuff.
Exactly. The algorithm saw that Building A was 0.2 miles from a 4.5-star rated sushi spot and a boutique apparel store that Yelp reviews described as charming. Building B was the same distance from a gas station and a convenience store with a 2-star rating in reviews that mentioned the word sketchy. The vibe was quantifiable.
So the algorithm quantified the vibe. And the result, according to McKinsey, was that this non-traditional data explained 60% of the changes in rent in Seattle.
60%. Think about that. So if you are an investor and you are ignoring the Yelp reviews and the coffee shops and just looking at the census data, you are missing more than half the picture.
So we have the street signs, we have the data, but what actually drives the change? What are the big engines? We touched on infrastructure, but let's go deeper into public transportation because the numbers here are pretty stark.
Transit is a massive, massive value driver. And this isn't just opinion. The data from the EESI and the National Association of Realtors bears this out. They did a fascinating study looking at the Great Recession from 2006 to 2011 when the entire housing market collapsed.
The ultimate stress test for any real estate theory.
The ultimate stress test. And what they found was an incredible resilience. Homes located near fixed rail transit stations, so subways, light rail, outperformed their surrounding regions by 41.6%.
Wow. So when everything else was tanking, being near the train station acted like a financial parachute.
A huge one. And in some cities like Boston, it was even more dramatic. Transit-adjacent homes there outperformed the rest of the region by a staggering 129%.
Why? Is it just about an easier commute to work?
That's part of it, for sure. But it's more about the lifestyle. This connects back to the preferences of millennials and Gen Z, the concept of the complete community. Younger generations, and frankly, increasingly older ones too, prefer a walkable lifestyle. They want to be able to get to work, get groceries, and get to entertainment without having to own 2 cars and sit in gridlock for an hour every day.
And high-frequency transit is the backbone of that lifestyle.
It is. And it brings in money. There are huge economic multipliers. The report cites Phoenix, where they invested $1.7 billion in their transit system. That sounds like a lot of taxpayer money. But it yielded $7 billion in economic development along that corridor. That is a massive return on investment.
So transit is one major engine. But there's another type of engine, one that's defined by the fact that it doesn't move. Anchor institutions.
Right, anchor institutions. This is a concept from the National Housing Conference. We're talking about large, place-based organizations like hospitals and universities. The key part of the definition is that they cannot move.
They're stuck there, for lack of a better word.
They are anchored. A corporate headquarters can pack up and move to Texas if the taxes are lower. A university cannot easily move its centuries-old campus. A major hospital cannot just relocate its emergency room and all its infrastructure. They are permanently tethered to the geography.
And that forces them to care about the neighborhood in a way a corporation might not.
It forces them to care. And that brings us to this really important concept of shared value.
Which is very different from just charity.
Very different. Charity is writing a check to a local cause because it feels good or it's good PR. Shared value is strategic. It recognizes that the institution's success is directly linked to the health of its surrounding community.
How so?
Well, think about a hospital. If it's surrounded by a neighborhood that is unsafe, has crumbling housing, and lacks healthy food options, that is fundamentally bad for business. It's hard to recruit top-tier doctors and nurses to work there. The patients coming into their ER are sicker because they live in poor conditions with high rates of asthma from moldy homes. So it is in the hospital's direct financial interest to stabilize and improve the neighborhood.
And we have a great case study for this. Bon Secours Hospital in West Baltimore.
A truly fascinating case study. West Baltimore as a community has faced significant challenges for decades. Disinvestment, vacant housing, poverty. Bon Secours didn't just donate money to outside groups. They became a housing developer.
A hospital building apartments. That's not what you normally think of.
It's radical, but it makes perfect sense. They rehabilitated over 640 units of affordable housing. They took vacant, blighted lots and converted them into clean and green spaces, little parks and gardens.
And why go through all that trouble? They're a hospital.
Because they realized that housing is healthcare. By stabilizing the housing, they directly improved the community's health. Fewer asthma triggers from moldy apartments meant fewer kids in their pediatric ER. Safer, cleaner streets meant their own employees were safer walking to and from work. They understood that by anchoring the neighborhood, they were protecting their own long-term viability and fulfilling their mission.
That is a powerful engine. Okay, on to the third engine. This is the one everyone complains about, but I think very few people actually understand. Zoning.
The invisible rulebook that governs everything.
We need to talk about this because, honestly, zoning sounds like the most boring topic on earth, but the sources, like the one from Walters and Company, suggest this is where the real money is made.
It's boring until you realize it dictates destiny. Think of a city map like a board game. Every single square on that board has a rule written on it. You can only build a single-family house here, or you can build a factory here, or this space must be a park.
Okay, I'm with you.
Now, let's say a parcel of land is zoned for a single house. It might be worth, say, $100,000. But if you, as a developer, can convince the city to change the rule for that exact same square of land to allow a 10-story apartment building, that land is suddenly worth $2 million.
And you haven't built anything yet. You haven't even drawn up the plans. You just changed the rule.
You change the permission. That is what's called a variance, or rezoning. And the Walters and Company report highlights this. The most sophisticated investors aren't looking for the best house. They are hunting for the variance. They are looking for the discrepancy between what is currently there and what could be allowed to be there in the future.
So they're betting on the rule change.
They are betting on future density. If they see a neighborhood full of single-family homes that sits right next to a brand-new transit stop, they know with almost 100% certainty that the zoning will eventually have to change to allow for more apartments to support that transit. They buy the dirt, they wait for the zoning board to change the color on the map, and boom, they've created immense value out of thin air.
Okay, so we have these powerful engines of change. Transit, anchors, zoning, they drive value up. But here is where we have to have the really hard conversation. When value goes up, who gets pushed out? This brings us to the social cost, gentrification and displacement.
This is the double-edged sword of neighborhood change, absolutely. And we need to be very precise with our terms here because people often use them interchangeably and they really aren't the same thing.
So let's define them based on the sources like the NCRC and Wikipedia.
Gentrification, in its strictest academic sense, is the influx of higher-income movers into historically divested neighborhoods. That influx leads to increased investment and rising property values. That's it. It's an economic process.
Okay. And displacement.
Displacement is the human consequence, and it can be twofold. There's cultural displacement, which is when the tastes, norms, and institutions of the newcomers supplant those of the existing residents. The historic church closes and becomes condos. The local diner that's been there for 50 years is replaced by a luxury bistro. The vibe of the place changes.
And then there's the more direct kind.
Then there's physical displacement, people actually having to leave their homes because they can no longer afford the rent or the property taxes.
We have a major study here from the NCRC, the National Community Reinvestment Coalition. What did they find about how common this process actually is?
This is the stat that really stops people in their tracks. According to the NCRC's nationwide study, gentrification is actually incredibly rare. Nationally, only about 9% of eligible census tracts actually gentrified during the study period.
Really? I'm going to push back on that a little. I live in a city, I'm sure many of our listeners do, and I see cranes everywhere. It definitely feels like it's happening on every corner.
And that feeling is real, but it's what we could call the superstar city bias. If you live in New York, San Francisco, Boston, Washington, D.C., you are living in the epicenter. You are in the 9%. The vast majority of gentrification in America is intensely concentrated in just a handful of big coastal hubs.
So what's happening in the rest of the country? In the other 91% of neighborhoods?
Stagnation. The sad and far more common reality for most low-income neighborhoods in America isn't that they're being bought up by rich hipsters. It's that nobody is buying them. They stay stuck in a cycle of disinvestment. They don't gentrify. They just remain stuck in poverty.
That's a really sobering check on the narrative. We worry so much about the neighborhood changing, but maybe the alternative, the neighborhood never getting any investment at all, is actually worse.
That is the central tension of this whole topic. But, and this is a huge but, the NCRC study is very clear that where gentrification does happen, the displacement that follows is often racialized and can be brutal.
What do they mean by racialized?
They found it's not just people moving. It's often a specific demographic being pushed out right before they can reap any of the benefits. Black and Hispanic residents are often the ones displaced before they can benefit from the rising property values. They suffer through the years of decay and disinvestment, and then just as the streetlights finally get fixed and a real grocery store opens, their rent triples and they're priced out.
That is the heartbreaking part of the story. They don't get to harvest the fruit of their long wait. But there is some nuance here regarding the displacement narrative, right? The Wikipedia sources cite some other studies that challenge this a bit.
There is a counter-narrative, and it's important to look at it. Some researchers, like Lance Freeman and Lei Ding, have published studies suggesting that low-income residents actually move at high rates, regardless of whether their neighborhood is gentrifying or not.
Why is that?
Poverty itself creates instability. People move because of a job loss, a medical issue, a family crisis. So their research suggests that sometimes the people moving out of a gentrifying neighborhood were going to move anyway for reasons that have nothing to do with a rent hike. The gentrification is a correlation, not always the cause.
And what about the people who managed to stay?
This is the really interesting part of the mobility debate. The data shows that low-income residents who manage to stay in a gentrifying neighborhood often see significant benefits. Their credit scores improve. They get access to better jobs that move into the area, better schools for their kids, and most obviously safer streets.
So if you can hang on, you benefit.
If you can hang on. But that is a very, very big if. And the health impacts are really mixed. On one hand, you get better access to healthy food and safer parks. On the other hand, the constant stress of rising rents and the anxiety of possibly being displaced, plus the loss of your social network, your neighbors, your church, that can cause real cardiovascular issues and mental health problems. It is not a simple good or bad. It's a complex and often painful disruption.
And the NCRC noted something really interesting about opportunity zones. These were supposed to be the government's big solution to drive investment into poor areas, right?
That was the idea, yes.
Yeah.
A tax break to incentivize investment.
Yeah.
But the data shows that 70% of the neighborhoods that gentrified are located within or adjacent to these opportunity zones.
So what does that tell us?
It raises a really big question.
Yeah.
Is that tax break capital actually helping the people who live there, or is it just acting as an accelerant for the displacement that was already happening? Is it just fueling the fire?
It's a tough, tough reality. We all want neighborhoods to improve. We want the potholes fixed. We want safer streets. But we don't want to destroy the community in the process. Which leads us finally to our last section. The future. Is there a way to do this better? A way to invest without destroying?
This is the solution space. And the sources we looked at, particularly from the Impact Investing Institute, point us toward a growing field called impact investing.
Investing with impact. Okay, let's get into the nuts and bolts of this. It sounds nice, but usually when I hear the words social impact, my brain translates that to lower financial returns. Are pension funds really going to take a haircut just to be nice?
That's the old way of thinking, and it's what held this field back for a long time. The new data suggests something completely different. This is about achieving a double bottom line. The goal is to allocate capital in a way that generates both competitive financial returns and a positive, measurable social impact. They aren't mutually exclusive.
Okay, give me an example. Walk me through the math on this. How does this actually work in the real world?
Let's look at the Real Lettings Property Fund in the UK. It's a great case study. They recognized a massive social problem: homelessness and the instability of people living in temporary accommodation. So they created a fund to tackle it.
And what does the fund do?
It's very simple. The fund raises money from investors and uses it to buy a portfolio of flats, just regular apartments. Then they lease those properties on a long-term basis to a partner charity, St. Mungo's, which in turn uses the apartments to house people who are at risk of homelessness.
Okay, so the charity pays the rent to the fund. Where does the charity get the money for that rent?
This is the key to the financial model. The rent is often paid using government housing benefits.
Hmm.
So the rental income stream for the fund is essentially government-backed. It is incredibly stable. It doesn't fluctuate if the stock market crashes or if there's a commercial real estate downturn.
So for an investor, it's almost like buying a government bond. It's safe, it's predictable.
Exactly. It's what financiers would call a defensive asset. And all the while, the physical property itself, the brick and mortar, is appreciating in value over the 10 or 20-year life of the fund.
Yeah.
So the investors get two things: the steady rental income, which is their yield, plus the capital appreciation when the properties are eventually sold.
So the investors make a competitive return, and the report says they housed over 950 people who otherwise wouldn't have had a stable roof over their heads.
Correct. It turns out that social and affordable housing, as an asset class, has strong credit fundamentals. It doesn't fluctuate wildly like luxury condos or commercial office space. In a recession, people still need a place to live. It's resilient.
We also have the example of Cbus in Australia. What was their model?
CBUS is a superannuation fund, basically, a huge pension fund for the construction industry. They partnered with the government to invest directly in developing new, low-income housing projects
Why was that a good fit for them?
because it created a perfect virtuous cycle for them. By funding these projects, they were creating construction jobs, which directly benefits their members, who were construction workers. And at the same time, they were building needed housing stock and getting a stable, long-term return for their pensioners. They are literally investing in their own ecosystem,
And Guy's and St. Thomas's Foundation in the UK.
a major health foundation. They made a commitment to allocate 5% of their entire multi-billion-dollar endowment to impact investing. They had this realization that they couldn't just keep all their money invested in generic stocks and bonds while their stated mission was to improve public health. They started looking for investments that actually make the world healthier, including stable, affordable housing.
It really seems like the big institutional money, the pension funds, the endowments, the foundations, is starting to look at this place-based lens.
They are. I think they're realizing that you can't just extract value from a community indefinitely. You have to cultivate it. If you destroy the community fabric, you eventually destroy the long-term value of the asset. So the smartest money today is trying to solve for both profit and people.
So we have traveled all the way from a coffee shop with 5 different kinds of milk to a big data algorithm that can predict rent prices, to a hospital that's building apartments, and finally to a pension fund that's fighting homelessness.
It is an incredibly complex ecosystem.
It really is.
Yeah.
Real estate isn't just bricks and mortar. It's this constant collision of the micro, your neighbor deciding to paint their fence, and the macro global capital flows and invisible zoning laws.
And all of us, just trying to find a place to live right in the middle of it all.
So here is where it gets really interesting for me looking forward. We talked about those McKinsey algorithms that can predict rent prices with 90% accuracy. They can explain 60% of the variance in a neighborhood's value with things like Yelp reviews and apparel stores.
Right. The predictive power is getting stronger every year.
So here's my question. If big data can predict exactly where a neighborhood is going, if they know the path of progress before a single shovel even hits the ground, does that eliminate the luck of real estate?
That is the provocative question, isn't it?
I mean, we used to think of real estate as this kind of frontier where if you had a good gut feeling and you worked hard, you could win. You could find that diamond in the rough. But if a computer knows that weighted vest joggers plus 3 independent coffee shops minus 1 check cashing place equals 170% appreciation over 5 years, who wins? Is it the person with the best gut or the person with the best data subscription?
The person with the best data wins the trade. But the community itself might lose its soul in the process. And here's the other, maybe more important side of that same coin. If we know exactly who will be displaced before it happens, if the algorithm flashes a warning that says this zip code will lose 40% of its low-income residents in the next 3 years with 95% confidence, do we then have a moral obligation to intervene?
We can't say we didn't know anymore. The data is there.
We can't. The dashboard is blinking red. The question for all of us is, do we use that predictive data to simply extract maximum profit from the inevitable? Or do we use it to build those anchors, to get ahead of the curve, and to stabilize the ship before it capsizes?
That is definitely something for you to think about the next time you see a We Buy Gold sign close down and a brand new Pilates studio open up in its place.
Pay attention to the signs. They are telling you the future.
Thanks for listening to The Deep Dive. We'll see you next time.
Take care.